Welcome to video 3D on income shifting. This is the second in our tax planning variables that we're going to cover in this module. And by now you should be noticing that, wow, these are actually pretty simple ways to think about tax planning. And the reality is they are. All three of these all together separately, doesn't matter how you look at it, fundamentally these are quite simple ideas. Now, of course, to get more complex, your knowledge of the tax law is going to have to go up. And don't worry, we're going to get there. But at least for now, we're going to finish out this module. We're going to talk about a few more planning things, and then we'll wrap it up. Okay, here we go. Income shifting involves adjusting the rate by shifting income between either entities, jurisdictions, or both. So I got to tell you, they're working in the office next to me today. So if you hear some weird noises, that's what's going on. All right, let's keep going. So Mr. Krabs is considering opening a new restaurant. And the tax rate on income is 5% in Bikini Bottom. And the tax rate on income is 9% in Shell City. And so when we think about where we're going to open this restaurant, it's pretty obvious what our solution's going to be here, right? So if everything else is equal, and although it almost certainly never is, let's pretend that for a moment hypothetically. Estimated income of $100,000, tax rate of 5% versus 9%, taxes of $5,000 versus $9,000. After tax, Mr. Krabs clearly ends up with more if he opens his restaurant in Bikini Bottom because they have a lower tax rate. That's a classic case of tax shifting by shifting income. Simply choosing to shift your income over towards the lower tax jurisdiction. Okay, let's look at a different example. So Mr. Krabs himself is in the 37% tax bracket. His daughter Pearl, which how we can explain how a crab has a whale as a daughter, well, let's not even go there. But Pearl is in the 12% tax bracket. So Mr. Krabs hires Pearl as a hostess at the Krusty Krab and pays her $8,000. And for this purposes of this example, we're just going to ignore employment taxes. So the Krusty Krab deducts $8,000 in wages, and now Pearl has $8,000 in income. So if we look, the $8,000 deduction is worth 37% or $2,960, and then Pearl receives that $8,000 as income. She pays tax of 12%, but that's only $960. So the net tax savings of shifting this income from under Mr. Krabs' ownership to Pearl's ownership is $2,000. And we could have calculated that because we knew that 8,000 times the difference in the tax rates, 37 minus 12, is going to result in a $2,000 savings. So Mr. Krabs has a marginal rate of 37%, and now he's considering incorporating the Krusty Krab. So the Krusty Krab would now be subject to a 21% corporate rate. So if we go through the same 100,000, we can see that taxes as a sole proprietor at 37%, that's 37,000. His after-tax cash flow is 63,000. Whereas, of course, at the corporate level, with only a 21% tax rate, the after-tax cash flow is 79,000. And so it would appear that corporations are going to be the winner here, but there are two layers of tax on a corporation, one at the corporate level and then a second one on the distributions of earnings and profits to that corporation's owners. So again, we can look at these two examples. If the Krusty Krab is a sole proprietorship, there's only one level of tax, and that's the amount of tax that's paid by Mr. Krabs. And therefore, any of the distribution of the earnings or the profits of his sole proprietorship, they're just his to keep. Krusty Krab, it's true, only has 21% tax, but then that post-tax distribution of $79,000 to Mr. Krabs, he has to pay dividend tax of 15% on. So there's a second layer of tax on that dividend, which means that the net after-tax cash flows are $63,000 as a sole proprietor and $67,000 plus change as a corporation. So again, it would appear the corporation is still the winner. However, in 2018, they invoked the qualified business income deduction for pass-throughs, and a sole proprietorship is in fact a pass-through. And so what happens is under the QBI deduction, and don't worry, we're going to cover the QBI deduction. We'll get there. Under the QBI deduction, 20% of the taxable income is eligible for a deduction, which means that as a sole proprietorship, Mr. Krabs' income is only $80,000. So now we take 80,000 times 37%. We can calculate his after-tax cash flow as 70,400. Of course, we had already calculated that for the corporation, which is not eligible for the QBI deduction because a corporation is not a pass-through. And we see now that ultimately the sole proprietorship wins. And to be honest, that's why the QBI deduction is out there. When they lowered the corporate tax rate to 21%, there was some recognition on the part of the lawmakers that it suddenly has shifted a big advantage to the corporate structure. And so as a result, they came back and created the QBI deduction. So recall that the QBI deduction does expire after 2025, whereas the corporate tax rate being lowered to 21%, that's permanent. Okay, one last iteration on this, I promise. So instead of paying himself all the after-tax cash flow, Mr. Krabs is going to use the profits to grow the restaurant business by reinvesting. So now, of course, that's completely inconsistent with the Mr. Krabs character as it's built on the cartoon, but roll with me. These are hypotheticals, and we're talking about a crab that owns a restaurant anyway. So as a sole proprietor, we already know that what's going to happen is he's going to take the 20% deduction, taxable income of $80,000. He's going to have to pay taxes of $29,600. The difference here is that those taxes are going to come out of what cash flow? Because remember that what Mr. Krabs wants to do is roll all of the profits back into the corporation. And so now he's got to pay tax on that $29,600, whether it's distributed to him or not. So that leaves only $70,400 to reinvest in the Krusty Krab. Whereas if it's a corporate entity and it chooses not to make a distribution to Mr. Krabs, then now the after-tax cash flow is $79,000 because that second layer of tax is avoided. So as you can expect, the complexities of the decision increase pretty easily by just considering a few non-tax factors. For example, the non-tax factor we considered was, well, what are we going to do with the after-tax cash flow? Are we going to reinvest in the business, or are we going to pay it to the owners? And the reality is there are lots of non-tax factors that need to weigh into all tax planning. And tax isn't even generally the first thing on the list for most businesses. And you know what? Rightfully so. Things like availability for talent, the cost of real estate, the cost of machinery, skilled labor. There's all sorts of things. Access to transportation. All these will almost certainly come before taxes. And I'm a tax guy, so I'm taking that pretty tough. Okay, so transactions between family members was one of the designs we just looked at, right? Between Mr. Krabs and Pearl. And the reality is children generally have lower marginal tax rates. Therefore, parents may often shift income to children, and so that way it's taxed at the child's tax rate. There are also transactions between owners and their businesses. So, for example, incorporating a business, thus shifting income from the individual to the corporation, as we saw, can result in lower current taxation. Shifting income from a corporation to an owner can also occur, right? If the tax rates differ the other direction. So the corporation can take deductions for deductible expenses like compensation to the owner, interest on loans from the owner, and rent on buildings owned by the owner. So this allows the owners to avoid double taxation on corporate profits. So IRS scrutiny of related party transactions, implicit taxes, the kiddie tax, negative publicity, judicial doctrines, which we'll talk about in a second, these all limit income shifting strategies. So Mr. Krabs wishes to shift income out of his corporation into himself. So one of the things he does is he maintains personal ownership of the land and the building, and then he rents those to the corporation. And let's say that Mr. Krabs, being the greedy crab that he is, sets rent at 100% of business profits. As a result, Krusty Krab Corporate has no corporate income, and therefore there's no double taxation. So under the related party transactions, the IRS is likely to assert that rent should be stated at fair market value. And it seems unlikely that any business would agree that fair market value is 100% of the profits they generate from their business. So you can see that the scrutiny that the IRS can level against plans like this is appropriate. So Mr. Krabs pays Pearl, as you recall, to be a hostess. The problem is, Krusty Krab is a self-seating restaurant. You walk in, you order from Squidward, then you sit down wherever there's an available table. Hostess is not actually a job. So as a result, the IRS could revalue that compensation to its market value, which conceivably could be as low as 0. Mr. Krabs uses profits to purchase investments that pay $10,000 in interest and dividends. Okay, so one of the ways that Mr. Krabs might shift his income to his daughter might be, well, here's what I'm going to do. I'm going to give the interest and dividends to you when I receive it. But you can't simply give away your income. Unless he actually puts those investments in Pearl's name, they remain his. And there's a famous metaphor, it's probably in your book, but if it isn't, you can certainly Google it, by Judge Leonard Hand, who says, the fruit never falls far from the tree, right? And that's absolutely true when it comes to income. If you're the tree, the fruit belongs to you. So let's see what would happen if Mr. Krabs did put it into Pearl's name. Well, the tax law taxes unearned income of certain minor children at trust income tax rates. So what happens is, part of the benefit, recall, was that Pearl was in the 12% or 10% tax rate category. But the reality is, unearned income over a certain level is going to be taxed under the trust tax table. And if you look at this table, you can see that very quickly the tax rates ramp up. By $12,500, you're already at the highest marginal individual rate. So what happens is that creates a substantial reduction in benefit from trying to do this sort of income shifting with unearned income, which is things like interest and dividends, rents and royalties. All right, that brings us to the end of Video 3D from Module 1. And our next one is our last planning variable. It's called conversion. And hopefully you'll see what that means when we go through the video. Thanks for watching.
Hey, how you doing, Brad?
Cooking. Daddy's homeboys. They shall serve no fries before their time.
I think this one's on you, dude. Who's got the Buku Dolores today?
Uno dinero.
What have you got, $50 man?
I got a cigarette.
I got Uno Nicolette.
Hey! You guys had shirts on when you came in here.
There's something happened to him, man.
Come on, Spicoli, just put the shirts back on. You see that sign?
No shirt, no shoes.
No dice.
Right. Learn it. Know it. Live it.
Well, he's the full hot already.